Silver just flashed a signal most people won't notice until it's gone. Trump announced tariff hikes on South Korean goods overnight. 15% jumped to 25%. Markets repriced risk immediately. Silver caught a bid. Gold moved. The visible spike is only layer one. If you're holding silver, watching metals, or trying to protect purchasing power, this moment matters. Here's what nobody's talking about. While price ripped higher, something underneath the candles started tightening. Physical premiums crept up. Vault inventories and select reports dropped. Lease rates showed quiet stress. Speculative shorts scrambled to cover, not predicting a moonshot, showing you a pattern that repeats. If you're here in the first hour, you're ahead of the crowd that only reacts after CNBC explains it. We build signal over noise here. Hit subscribe, comment signal if you're watching metals right now. Here's what happened in plain terms. Trump administration raised tariffs on South Korean imports from 15% to 25%. Markets processed the shock. Risk-off flows accelerated. Safe haven assets caught bids. Silver moved sharply higher within minutes. Gold followed. That's the surface layer. Everyone saw the price move. Almost nobody saw the structure shift. Physical premiums for retail bullion started widening. Not dramatically, not yet. But the spread between spot price and what you actually pay for a coin or bar began creeping higher. Wholesale dealers started reporting tighter availability on certain products. COMEX open interest shifted. Speculative positioning showed aggressive short covering. When price rises but open interest falls, that's not FOMO buying. That's fear covering. Circle that. Let me show you the mechanism most people miss. I call it shock scramble squeeze. Policy shock hits, trade war escalation, tariff announcement, banking scare, geopolitical flare-up. The trigger doesn't matter. What matters is the sequence that follows. First comes the shock. Markets reprice risk immediately. Participants who were leaning one direction suddenly reverse. Safe haven assets catch bids. Gold moves, silver moves. This part is visible. Everyone sees it. Headlines cover it. Then comes the scramble. This is where it gets interesting. Speculative shorts who were betting on weakness suddenly face losses. They scramble to cover. Longs who were waiting for confirmation suddenly pile in. Industrial buyers who were comfortable waiting suddenly worry about securing supply. Physical buyers who were patient suddenly feel urgency. Liquidity starts thinning. Think of the market like a valve on a pipe. When everything's calm, the valve stays open. Buy orders flow through. Sell orders flow through. Price moves smoothly. But when a policy shock hits, that valve starts closing. Fewer sellers want to let go at current prices. Buyers who were passive suddenly turn aggressive. The valve chokes. Pressure builds behind it. Then comes the squeeze. Price releases upward in bursts. Not smooth, not gradual. Sharp moves that feel disproportionate to the news. Silver's liquidity is thinner than gold, so the effect amplifies. A 2% move in gold becomes a 5% move in silver, sometimes more. Not telling you silver always rips higher after tariff news, showing you the pattern when it does. I've watched this play out during trade war headlines in 2018 and 2019, during banking stress in early 2023, during Middle East escalations. The trigger changes, the sequence repeats. Your job is to recognize the structure, not predict the outcome. Here's what makes this week different. The shock came fast. Trump announced the tariff increase overnight. No warning, no gradual escalation. Markets had to adjust instantly. That speed matters. When participants don't have time to position gradually, the scramble phase intensifies. Silver jumped from mid-$30 range to higher levels within hours. That's the visible move. But open interest on COMEX futures started shifting in ways that suggest shorts covering, not fresh speculative longs piling in. When price rises on short covering rather than new buying, it tells you fear is driving the move more than greed. Fear-driven moves tend to be sharper and shorter, but they can also set up conditions for sustained runs if the underlying tension doesn't release. Think about that. Now, let me show you the layer beneath that. Every major silver run of the last decade started with something that looked temporary, a headline, a shock, a scare. Then the temporary thing revealed deeper tension in the system. That tension shows up in the gap between paper markets and physical markets. COMEX futures can absorb selling easily. Contracts trade electronically. No metal moves, just promises. When sellers want out, buyers step in. Price adjusts. System stays liquid until it doesn't. When physical buyers step in aggressively, the system strains. Physical silver has to be sourced, transported, vaulted, delivered. That takes time. That requires inventory. That depends on participants willing to let go of real metal at current prices. When those participants start holding tighter, the physical premium over spot price widens. Normal premium on a retail silver coin might be 3 to 4% over spot. When stress enters the system, that premium can jump to 6, 8, 10%, sometimes higher. That spread is a signal. It tells you physical buyers are willing to pay significantly more than the futures price to secure actual metal. Why does that matter? Because if futures price is $32, but you can't buy a coin for less than $35, the real price isn't 32. It's 35. The futures market is lying to you about true clearing price. Not always, not in calm times, but during stress, that gap becomes the story. Right now, premiums are elevated but not spiking. Dealers report tighter availability on certain products, but not shortages. Lease rates are showing quiet stress, but not panic. These are early signals. Could reverse tomorrow if tariff rhetoric cools. Could intensify if another shock lands while inventories are already thinning. Your job is to watch the gap, not predict which way it goes. Let me walk you through how this shows up in the real world. Imagine you're a wholesale dealer. You source large quantities of silver from refiners and mints. You sell to retail dealers. Your margin depends on managing inventory and timing your purchases. When a policy shock hits and price jumps, you face a decision. Do you restock inventory at higher prices, knowing you might have to sell lower if the move reverses? Or do you hold tight, knowing that if the move extends, you'll run out of product and lose sales? If enough dealers hold tight, physical availability shrinks. Retail buyers start seeing out-of-stock notices. Delivery times extend. Premiums widen. That feedback loop can accelerate quickly. Not saying that's happening right now. Saying the conditions are tightening in ways that make that loop more likely if another shock lands. COMEX inventories and registered vaults have been grinding lower over recent months, not collapsing, not at crisis levels, but the trend is down. When deliverable inventory shrinks while speculative interest stays elevated, the system becomes more sensitive to shocks. Lease rates are another early indicator most people ignore. Silver lease rates reflect the cost to borrow physical metal. When lease rates rise, it signals tighter availability. Participants who need silver for industrial use or delivery obligations are willing to pay more to secure it short term. Lease rates have been creeping higher, not spiking, not screaming, but rising. That's a yellow light, not a red light, but yellow lights matter when you're driving into a curve. Here's what you need to sit with. Most people are asking, will silver go up? That's the wrong question. The real question is this: what happens if the next tariff headline lands while inventories are already thinning, premiums are already elevated, and speculative shorts are already covering? What happens when the valve is already halfway closed and another shock tries to force through? Systems don't break when they're calm. They break when stress hits a system already under tension. Silver's price chart looks volatile but manageable. The structure underneath looks tighter than price suggests. That gap is what we watch, not predicting a squeeze, watching whether conditions are aligning for one. Circle that distinction. Let me walk you through the paths I'm watching this week. Scenario 1, tariff escalation and dollar weakness. If Trump administration announces additional tariffs on other trading partners and the dollar index starts dropping, safe haven flows into metals likely persist. Silver strength extends. Physical premiums may widen further. Industrial buyers might accelerate purchases to lock in supply before costs rise. Watch whether gold-silver ratio compresses. If silver outperforms gold on a percentage basis, that signals speculative interest is layering on top of safe haven flows. Not a guarantee, a signal. Scenario 2. Rhetoric cools, markets stabilize. If tariff news fades or gets walked back, risk-off flows reverse. Silver price may pull back. Speculative longs take profit, shorts reload. But here's what to watch. Do physical premiums refuse to fall? If spot price drops but retail premiums stay elevated, That tells you physical buyers aren't letting go. The paper market is correcting, but the physical market is holding firm. That's a sign of deeper structural tension. Scenario 3. Retaliation escalates. If South Korea or other nations announce retaliatory tariffs, trade war headlines intensify. Markets reprice geopolitical risk higher. Safe haven assets catch sustained bids. This is the path where short covering transitions into fresh buying, where scramble phase transitions into squeeze phase, where price moves stop feeling temporary and start feeling structural. Can't know which scenario plays out. Can only track which signals are confirming or denying each path. Here's what I'm tracking this week. COMEX silver, open interest versus price. If price rises and open interest rises, that's fresh speculative buying, longs piling in. That type of move can extend but also reverses quickly when sentiment shifts. If price rises and open interest falls, that's short covering, fear-driven. Those moves tend to be sharper but shorter, unless physical tension compounds. If price falls and open interest rises, that's fresh shorts entering. Bearish positioning. Watch whether physical premiums diverge from futures price. Normal looks like open interest moving roughly in line with price. Stress looks like divergence. Retail bullion premiums. Check major dealer websites. Compare premium over spot for generic rounds and government coins. Normal premium is 3 to 5%. Stress premium is 6 to 10%. Panic premium is 12+%. Right now, we're in the elevated range. Not panic, not normal. If premiums widen further while spot price stays flat or drops, that's physical buyers stepping in aggressively despite paper weakness. Strong signal. If premiums compress back toward normal, tension is releasing. Weaker signal. Dollar index reaction to tariff news follow through. If dollar strengthens despite tariff escalation, that creates headwind for metals. Risk-off flows split between safe haven currencies and safe haven metals. Silver has to fight harder. If dollar weakens as tariff news continues, metals catch double tailwind. Safe haven flows and currency debasement fears both push prices higher. Watch DXY at key support and resistance levels. Mid to high 90s is normal range. Break below support could accelerate metals rally. Break above resistance could cap it. Gold-silver ratio compression or expansion. Gold-silver ratio measures how many ounces of silver equal 1 ounce of gold. Normal range is roughly 70 to 90. When ratio compresses toward 70 or below, silver is outperforming. When ratio expands toward 90 or above, gold is outperforming. If ratio compresses while both metals rise, that signals speculative interest layering onto safe haven flows. Risk appetite for silver specifically is increasing. If ratio expands while both rise, gold is leading, silver is following. Safer bet, but less explosive upside. Right now, ratio is mid-80s. Watch whether it breaks lower or holds. Headlines on retaliatory trade actions. This is qualitative, not quantitative, but it matters. If South Korea, China, or EU announce retaliatory tariffs, trade war escalation becomes the primary narrative. Markets reprice geopolitical risk. Metals catch sustained attention. If rhetoric softens or negotiation headlines appear, risk-off flows fade. Your job is to track news flow intensity, not predict outcomes. If you're an active trader, respect volatility. Silver can rip 5% higher and give it all back in 2 days. Size positions accordingly. Use stops. Don't chase after sharp moves. If you're a long-term holder, accept pullbacks. Thesis doesn't play out in straight lines. Structure matters more than daily price. If you're exploring metals for the first time, understand what you're stepping into. This isn't a savings account. This is a volatility trade with safe haven characteristics. Know what you own, could reverse, could consolidate, could extend. Markets trap the overconfident every time. We don't chase, we observe. Here's what this comes down to. Price is the headline. Structure is the story. We study the story. If you track these signals, you're in the group that sees pressure before price. You're early. You're calm when others panic. You're positioned when others are still reading yesterday's news, not telling you to buy, not telling you to sell, showing you what to watch and how to interpret it. That's the difference between reacting and understanding. Silver flashed a signal this week. Tariff shock triggered safe haven flows. But beneath that visible move, the system showed signs of tightening. Physical premiums elevated. Lease rates crept higher. Inventories trended lower. Shorts scrambled to cover. Those signals don't guarantee price goes higher. They tell you the structure is under more tension than the chart shows. And systems under tension respond differently to shocks. If you stay disciplined, watch the signals we covered, and respect the volatility, you put yourself in the group that doesn't get shaken out when the next headline hits. That's the edge. Hit subscribe if you want more pattern breakdowns like this. We don't hype, we don't predict. We show you what to watch. Drop a comment with which signal you're tracking most closely. Do you watch premiums, open interest, dollar index, or are you tracking something else entirely? And if you've ever spotted a move early by watching structure instead of price, share that story. The community learns from those moments. Links to tools for checking premiums, COMEX data, and Vault reports are below. Your job this week is simple. Watch the gap between paper and physical. Track open interest versus price. Monitor premium spreads. Note headline intensity. Don't predict. Observe. Price is the headline. Structure is the story. We study the story.